Banks quietly power the global economy by moving money safely between people, businesses, governments, and financial markets every single day. Almost every salary, payment, mortgage, investment, and business transaction depends on banks working efficiently behind the scenes every day. But how can owning a bank generate enormous wealth while managing trillions of dollars flowing through the financial system annually? Every bank performs 4 essential functions daily: accepting deposits, issuing loans, processing payments, and protecting customer money safely. Banks connect savers with borrowers, allowing money to circulate efficiently and helping economies grow stronger through continuous financial activity. People trust banks because they securely protect money, valuables, important documents, and financial records through advanced security systems every day. Today, banks safely protect trillions of dollars belonging to families, businesses, governments, institutions, and investors across the world. Without banks, salaries, investments, international trade, and everyday business transactions would become slower, riskier. Banks create confidence by allowing people and businesses to save, borrow, invest, and transfer money safely with predictable financial stability. Before exploring profits, let's understand how modern banks became one of history's most influential financial institutions, serving billions worldwide today. Banking began thousands of years ago, when merchants needed secure places to store valuables and exchange different forms of money. Ancient temples often served as trusted financial centers, where valuable assets were safely stored and carefully recorded for generations. As global trade expanded, banking services evolved to help merchants transfer wealth safely across distant cities and kingdoms efficiently. The Italian Renaissance transformed banking by introducing organized accounting, financial partnerships, and professional lending institutions. Modern banks inherited centuries of innovation, becoming trusted financial institutions supporting economic growth, investment, and global prosperity for everyone. Today, banks safely connect billions of people through deposits, payments, lending, investments, and secure digital financial services every day. Despite offering many services, nearly every banking business follows one surprisingly simple economic model for generating sustainable profits consistently. Everything begins when customers trust a bank enough to deposit their hard-earned money into secure accounts for future needs. Those customer deposits become the foundation that allows banks to finance homes, businesses, education, and economic growth across entire nations. Next, we'll discover how banks transform ordinary customer deposits into profitable loans while carefully managing financial risk and maintaining trust. Everything starts with customer deposits, because they provide banks the financial foundation needed to lend, invest, and generate long-term profits. When customers deposit money, banks record those funds as liabilities because they remain legally owned by depositors at all times. Although deposits belong to customers, banks responsibly use much of that money to create carefully managed, profitable loans daily. Banks never lend every deposited dollar because sufficient reserves protect customers and maintain confidence during unexpected financial emergencies everywhere. Maintaining customer confidence is essential because trust encourages deposits, supports lending, and keeps the entire banking system operating smoothly. Customer deposits arrive continuously through salaries, businesses, transfers, cash deposits, and digital payments. Banks encourage larger deposits by offering convenience, security, digital access, and sometimes interest rewards for customer savings accounts. Different deposit accounts serve different purposes, helping customers manage spending, saving, investing, and planning for future financial goals successfully. Banks carefully monitor deposit balances every moment to maintain liquidity and ensure customers always access their available money safely. Banks also verify employment, monthly income, existing debts, and available collateral before approving significant loans for qualified applicants. Before approving loans, banks carefully evaluate every applicant's income, financial history, repayment ability, and overall credit scores. Help banks predict repayment behavior using financial history, outstanding debts, and previous borrowing performance over many years. Welcome to risk-based pricing. As you can see, excellent credit borrowers receive the lowest interest rates, while those with poor credit pay significantly more. Banks also verify employment, monthly income, existing debts, and available collateral before approving significant loans for qualified applicants. Only qualified borrowers receive approved loans, protecting customer deposits while generating reliable interest income for the bank over many years. After loan approval, banks transfer funds to borrowers while recording every repayment schedule, interest rate, and payment obligation accurately. Every monthly repayment repayment returns borrowed money plus interest, creating predictable cash flow that supports profitable banking operations over time. Interest represents the price borrowers pay for accessing money today, instead of waiting years to accumulate enough personal savings. Banks earn sustainable profits when interest income consistently exceeds funding costs, operating expenses, and expected credit losses over time. Next, we'll explore how interest rates determine bank profits and influence borrowing, saving, investing, and overall economic activity worldwide today. Interest rates determine borrowing costs, savings returns, bank profitability, investment decisions, and the overall pace of economic growth worldwide today.
Banks earn income by charging borrowers higher interest rates than they pay customers for deposited savings and checking accounts.
This difference between earned and paid interest is called the net interest margin, powering most commercial banking profits. Even small changes in interest rates can significantly increase or reduce bank earnings across millions of active customer loans. Understanding interest margins explains why lending remains the single most important source of long-term revenue for commercial banks worldwide today. Banks also generate revenue through account fees, payment services, wealth management, and financial products beyond traditional lending activities alone. Service fees provide stable income because customers continue using banking services regardless of changing interest rates throughout economic cycles consistently. Large banks diversify revenue by offering investment banking, asset management, insurance, brokerage, and corporate financial advisory services globally. Diversification reduces financial risk because multiple revenue sources continue generating income even when individual markets temporarily weaken significantly. Next, we'll discover how fractional reserve banking expands lending capacity and influences money creation across the modern financial system worldwide.
Banks do not simply store money. They continuously recycle deposits into productive loans that support economic growth and innovation.
Fractional reserve banking allows banks to lend most deposits while safely keeping enough reserves for normal customer withdrawals and confidence. Every new loan creates additional spending power, helping businesses expand, consumers purchase goods, and economies generate stronger, Responsible lending stimulates growth, while excessive lending can increase financial risks and threaten long-term economic stability for everyone involved.
This explains why banking regulations require institutions to maintain adequate reserves, liquidity, and capital.
Banking regulations exist to protect depositors, maintain financial stability, prevent crises, and strengthen confidence throughout the entire banking system.
Banks must maintain minimum capital because unexpected losses can occur during economic downturns, market crashes, or borrower defaults unexpectedly.
Capital represents the bank owner's investment, providing protection before customer deposits become exposed to financial losses during difficult periods. International banking standards require financial institutions to maintain healthy capital ratios that strengthen resilience against future economic uncertainty worldwide. Next, we'll examine how central banks influence interest rates, inflation, lending, and economic growth through monetary policy decisions worldwide. Central banks manage national monetary policy by influencing interest rates, controlling money supply, and maintaining long-term economic stability nationwide today. Unlike commercial banks, central banks rarely serve ordinary customers and instead supervise the nation's entire financial system and currency. When inflation rises too quickly, central banks often increase interest rates to slow borrowing and consumer spending across economies. Lower interest rates encourage borrowing, business investment, home purchases, and consumer spending during periods of slower economic growth nationwide.
Finding the right balance between inflation and economic growth remains one of every central bank's greatest ongoing responsibilities today. Even profitable banks can experience serious problems if too many customers suddenly withdraw their deposits at the same time together.
This event is called a bank run, where fear spreads faster than facts and confidence disappears almost instantly everywhere.
Most bank runs happen because people panic, not because every bank has completely exhausted its available financial resources already.
Deposit insurance increases public confidence by protecting eligible customer deposits if an insured bank unexpectedly fails during financial crises. Next, we'll examine famous banking crises and discover the important lessons they taught governments, regulators, banks, and investors worldwide together. History shows that banking crises often begin with excessive risk, weak regulation, falling confidence, and rapidly spreading financial panic everywhere. The Great Depression caused thousands of banks to fail, permanently changing financial regulation and public confidence across America forever. The 2008 financial crisis exposed dangerous lending practices, weak risk management, and excessive borrowing throughout global banking markets. After every major crisis, governments strengthen banking rules to improve transparency, stability, capital, and long-term financial resilience for everyone. Successful banks survive difficult periods by balancing profitability, liquidity, capital strength, discipline, and lasting customer trust. Today's banks increasingly rely on digital technology, artificial intelligence, automation, and cybersecurity to serve customers faster. Mobile banking allows customers to transfer money, pay bills, invest, and manage finances from virtually anywhere, anytime securely. Artificial intelligence helps banks detect fraud, evaluate credit risk, improve customer service, and strengthen security every single day automatically. Cybersecurity has become essential because modern banks protect enormous amounts of sensitive financial information against constantly evolving digital threats worldwide. Next, we'll discover whether owning a bank is truly profitable after considering risks, regulations, competition, and future technological transformation together. Owning a successful bank can generate enormous wealth because millions of financial transactions create reliable income every single day worldwide. Large banks earn billions annually because they serve millions of customers across lending, payments, investments, and wealth management services.
However, profitability always depends on disciplined lending, effective risk management, operational efficiency, and maintaining strong.
Poor lending decisions can quickly erase years of profits, damage confidence, and threaten the entire institution's long-term financial stability. The world's strongest banks succeed by balancing profitability, innovation, customer trust, regulatory compliance.
From international bank headquarters to local businesses and families, digital networks connect every continent.
These institutions process billions of transactions daily while financing international trade, infrastructure projects, innovation, and economic development across continents together.
International banking enables businesses to exchange currencies, finance exports, import goods, and expand confidently into new global markets successfully.
Competition from fintech companies encourages traditional banks to innovate faster, improve customer experiences, and reduce service costs continuously worldwide. Next, we'll summarize everything learned and answer whether owning a bank remains one of history's greatest business opportunities today, together.
We've learned that banks transform customer deposits into productive loans, fueling businesses, innovation, homeownership, and sustainable economic growth every day.
Successful banking depends on balancing profitability, customer trust, regulatory compliance, innovation, liquidity. Technology continues transforming banking through artificial intelligence, automation, cybersecurity, digital payments, and faster financial services for everyone globally.
Understanding banking helps investors, entrepreneurs, consumers, and policymakers make smarter financial decisions.
One simple idea connects everything. Trust remains the true foundation supporting every bank, transaction, loan.
Without banks, businesses would struggle to expand, families could rarely afford homes, and economic progress would slow dramatically everywhere worldwide.
Every deposit, payment, loan, investment, and transaction connects people through one enormous financial network, supporting global prosperity every single day. Understanding how banks operate reveals why finance influences nearly every business, career, investment, and personal financial decision we make together.
Behind every successful economy stands a trusted banking system connecting savings, investment, innovation, entrepreneurship. Beyond traditional banking, major institutions help companies raise capital through investment banking, supporting business expansion, innovation. Investment banks advise corporations on mergers, acquisitions, restructuring, financing strategies, and large-scale business transactions across international financial markets today.
Companies often issue shares to investors instead of borrowing money, allowing businesses to raise enormous amounts of permanent capital efficiently. Investment banks organize initial public offerings, helping private companies become publicly traded businesses on major stock exchanges worldwide. Successful public offerings provide businesses with fresh capital while giving investors opportunities to share future company growth and long-term profits. Besides selling shares, companies also borrow money by issuing bonds that promise investors regular interest payments until maturity dates arrive. Unlike shareholders, bond investors usually receive fixed interest payments without owning any portion of the issuing company's business operations. Governments issue bonds to finance highways, hospitals, schools, infrastructure projects, and other important public investments, benefiting millions of citizens. Investment banks connect governments and corporations with investors, ensuring large fundraising projects successfully reach financial markets around the world together. Next, we'll explore international banking systems that move trillions across borders every day through secure global financial networks efficiently together.
International banking enables people and businesses to move money securely across countries for trade, investment, tourism, and everyday finance.
Banks exchange secure payment instructions through international communication networks instead of physically moving enormous amounts of cash between countries daily. Correspondent banking allows financial institutions without foreign branches to complete international transactions using trusted banking partners across worldwide markets together. Foreign exchange markets convert currencies instantly, allowing international trade, travel, investing, and cross. Next, we'll discover how financial technology transforms traditional banking through digital innovation, automation, faster payments, instant payments, QR transactions, digital wallets, budgeting, investments, and automated savings. Fintech simplifies finance. Digital wallets allow customers to store payment information securely while making purchases instantly using smartphones instead of physical cash everywhere.
Open banking securely shares financial information between authorized institutions, encouraging innovation, competition.
Traditional banks increasingly collaborate with fintech companies instead of competing directly, combining trust, innovation, technology, and customer convenience successfully together. Next, we'll explore blockchain technology, cryptocurrencies, digital currencies, and their growing influence on tomorrow's global banking systems together worldwide.
Blockchain records transactions across thousands of computers, creating transparent, secure, and tamper-resistant digital ledgers.
Every verified block permanently links with previous blocks, making transaction histories extremely difficult to modify without widespread network agreement afterward. Bitcoin introduced decentralized digital money, allowing users to transfer value directly without traditional banks processing every transaction between participants. Thousands of cryptocurrencies now exist, each offering unique technologies, payment solutions, investment opportunities. Next, we'll examine cryptocurrency advantages, potential risks, market volatility, regulations, and their future relationship with traditional banking systems together. With our platform, global payments are fast and seamless. The funds are verified across the blockchain and delivered in. However, cryptocurrency prices can fluctuate dramatically, creating significant investment opportunities while exposing investors to substantial financial risks and uncertainty daily. Governments continue developing regulations that encourage innovation while protecting consumers, investors, financial markets, and economic stability. Many financial institutions now offer cryptocurrency services alongside traditional banking, expanding customer choices through regulated digital asset investment platforms safely. Next, we'll explore central bank digital currencies and discover how governments are modernizing national money for the digital economy together. Unlike cryptocurrencies, central bank digital currencies remain backed by governments and supported through official national monetary authorities for stability.
Digital national currencies could improve payment efficiency, reduce transaction costs, and strengthen financial inclusion across entire populations. Many countries continue researching digital currencies while carefully evaluating privacy, cybersecurity, scalability, resilience. AI optimizes every banking operation in real time. From fraud detection to personalized recommendations and robotic automation, artificial intelligence analyzes millions of financial transactions every second, identifying suspicious behavior far faster than traditional manual review methods available. Machine learning continuously improves credit risk predictions by analyzing customer behavior, repayment history, income patterns, and financial performance automatically together. AI-powered virtual assistants answer customer questions instantly, reducing waiting times while improving banking support around the clock every single day. Banks increasingly automate repetitive tasks, allowing employees to focus on complex financial decisions and personalized customer relationships more effectively today. Next, we'll discover how tomorrow's banking industry may evolve through quantum computing, digital identity, and advanced financial technologies shaping humanity together. Future banks may use quantum computers to solve complex financial calculations dramatically faster than today's most powerful computer systems worldwide together. Quantum technology could improve fraud detection, portfolio optimization, cybersecurity, financial forecasting, and advanced banking analytics beyond current capabilities dramatically together. Digital identity systems may replace passwords by securely verifying customers using biometrics, encrypted credentials, and advanced authentication technologies everywhere together. Advanced cybersecurity will continuously evolve because cyber threats become increasingly sophisticated alongside rapidly advancing digital financial technologies every single year. Tomorrow's banking experience will become faster, safer, smarter, and increasingly personalized through continuous technology.
By 2050, banking may become nearly invisible, operating automatically through intelligent systems integrated in. Artificial intelligence could provide every customer with personalized financial advice based on spending habits, goals, risks, and future opportunities automatically. Smart contracts may automatically execute financial agreements once predefined conditions are satisfied, reducing paperwork, delays, and administrative costs significantly everywhere. Banks of tomorrow will combine human expertise with intelligent automation, delivering safer decisions, faster services, and next, we'll examine the world's most powerful banking empires and discover how they shaped global finance throughout modern economic history together. Throughout history, powerful banking institutions financed kingdoms, industries, infrastructure, and international trade, shaping modern. Today's largest banks manage trillions of dollars while supporting governments, corporations, entrepreneurs, investors, and households across global financial markets every day. Financial centers connect global capital, attracting investment, innovation, multinational businesses, and skilled professionals from every region around the world continuously. Healthy competition among international banks leads to digital innovation, lower fees, and satisfied customers. Next, we'll discover legendary banking families, visionary founders, remarkable success stories, and lasting lessons from centuries of financial leadership together.
Successful banking families built trust over generations by financing commerce, supporting innovation, and maintaining
Great banking leaders focused on managing risks carefully while identifying opportunities that created sustainable prosperity for businesses, investors, and communities together. Reputation remains one of banking's greatest assets because customer confidence determines long-term success more than impressive buildings or expensive technology. History proves banks that embrace innovation while protecting customers usually remain competitive through changing technologies,
Next, we'll uncover financial crises, banking failures, economic recoveries, and valuable lessons shaping stronger banking systems.
Financial crises often begin when excessive borrowing, risky investments, and falling confidence combine to weaken banks and entire economies rapidly together. When depositors panic and withdraw money simultaneously, even healthy banks may experience severe liquidity pressure within very short periods unexpectedly. Central banks provide emergency liquidity during crises, helping stabilize financial institutions and restore confidence throughout the banking system quickly together. Governments sometimes guarantee deposits to reassure customers, reduce panic, and maintain stability during periods of financial uncertainty and economic stress.
Every major financial crisis teaches valuable lessons, leading governments and banks towards stronger regulations and better risk management practices together.
The 2008 financial crisis began after risky mortgage lending and collapsing housing prices severely weakened banks across multiple countries worldwide simultaneously. As mortgage defaults increased dramatically, complex financial products rapidly lost value, spreading uncertainty across global. Several governments introduced emergency rescue programs, stabilizing banks, protecting depositors, and restoring confidence throughout fragile Following the crisis, regulators strengthened banking rules requiring larger capital reserves, improved transparency, and stricter financial supervision.
Building wealth begins with disciplined saving, allowing small deposits to grow steadily through interest, investments, and consistent long-term financial habits together.
Successful investors diversify assets across different investments, reducing overall risk while increasing opportunities for stable long-term financial growth and security. Responsible borrowing supports financial growth, while excessive debt without repayment planning can create lasting financial stress and reduced future opportunities significantly. Emergency savings provide financial protection during unexpected expenses, helping families avoid unnecessary debt and Next, we'll summarize banking's greatest lessons before exploring the future opportunities awaiting tomorrow's global financial systems and economies together worldwide. Banking succeeds because trust transforms individual savings into productive investments that create jobs, businesses, innovation. Every financial decision influences future opportunities, making careful planning, disciplined investing, and responsible money management.
Technology will continue transforming finance, yet transparency, integrity, customer confidence, and responsible leadership will always remain.
Understanding banking empowers individuals to make smarter financial choices, build lasting wealth, and confidently participate within the global economy every day. Next, we'll conclude by revealing banking's lasting economic impact and why strong financial systems remain essential for humanity's shared future together. Strong banking systems encourage entrepreneurship, innovation, infrastructure development, international trade, and Financial knowledge helps people protect wealth, avoid unnecessary risks, build successful businesses, and achieve long-term. The future of banking depends on balancing technological innovation, cybersecurity, transparency, customer trust. In our final chapter, we'll summarize everything you've learned and reveal why banking remains civilization's most powerful financial invention ever created. Every deposit represents confidence, every loan creates opportunity, and every successful investment helps strengthen economy.
Responsible banking balances innovation with stability, ensuring financial progress never sacrifices customer trust.
Financial literacy empowers ordinary people to confidently save, invest, borrow wisely, and build lasting prosperity through informed decisions every single day.
Understanding banking means understanding how modern civilization finances progress, solves challenges, and creates opportunities for.
Only 5 scenes remain before our journey ends, revealing banking's ultimate impact on humanity, prosperity, and the future of global finance together.
Banking transforms civilization by turning individual savings into global prosperity, innovation, infrastructure, opportunities. The strongest financial systems combine trust, innovation, responsibility, transparency, and resilience to create. Tomorrow's financial future belongs to informed individuals who understand banking, embrace technology, manage risks wisely.
Thank you for exploring banking's remarkable journey from ancient trade to intelligent finance, shaping tomorrow's global economy for future generations together. If you enjoyed this documentary, subscribe for more fascinating economic stories explaining money, business, innovation,